So do you know from the year 2000 till now, Infosys earnings have grown by 25% CAGR. So that's like 25% average growth every year. But during the same period, that's a 25-year period, the stock price for Infosys has grown only about 9 to 10%. Now, I know that sounds really shocking, but Infosys over the last 20-25 years has not delivered anything. And what's the reason for that? The reason for that is that in the year 2000, Infosys was trading at a price to earnings multiple of 200. It was a great stock. It was a company which was supposed to last. The euphoria around the company in that year was at its peak and everyone was buying it. You can compare it to the euphoria you have around, stocks like Zomato or Eternal or some of these defense stocks. But the fact is that if you buy stocks which are trading at extreme valuations, even if the company does very well and the earnings keep improving, it's going to take a long time for the company's earnings to match up to its valuations and for the stock to deliver any meaningful returns in terms of the stock price. And today I'm going to talk about exactly that. If valuations had any logic in these markets, then there was no reason why a stock like Eternal would be trading at 1700 to 1800 price to earnings, and a stock like LIC Housing Finance or PNB Housing Finance. Basically, a lot of these housing finance stocks would be trading at 5 to 6 kind of multiples. What should happen is things should be the other way around, because there's a lot of tailwinds for housing finance, and a lot of these tech-focused, new age delivery app-based companies are trading at some insane valuations, and yet people keep buying them because the buzzword these days is growth. Just like in undervalued markets, everybody talks about value. In super overvalued markets, storytelling becomes a very interesting thing to do, and you can justify anything with future growth potential. Now, to be honest, if you talk about Eternal, Zomato, I'm talking about, for the stock to be trading at a multiple of 40 to 50, the earnings have to improve 4,300% from where they are. Now, I know, this is a business which has very, very good future. I like the business. I like the business model. Everybody's going to take to, home delivery, and this is a very, very growing area. But 4,300% improvement in earning, I doubt it's going to happen at least in the next 4 to 6 years, and even if it does, it's not like then the stock becomes cheap. It just becomes reasonable. So today I'm going to talk about valuations, and how I'm going to do that is I'll take 5 core sectors of the Indian economy, and I'm going to talk about 3 to 4 stocks in each sector. Now keep in mind, I like all of these stocks. So I'm not going to talk about stocks which I like and stocks which I don't like. I'm going to talk about stocks which I like. The only difference between the stocks from each sector that I pick up would be some of these stocks are trading at extreme valuations while other stocks are trading at reasonable valuations. So I'm comfortable buying into those stocks. So the sectors I'll be covering for this is banking and financial services, information technology, oil and gas, which is energy, FMCG, and healthcare. Now, together, these sectors constitute about 65% of the Nifty 50 companies, and they form the core of the Indian stock markets. I've on purpose left out telecommunications and auto sector because I want to cover that separately in another video. But just for valuations, I'm going to take these sectors and pick up stocks from these sectors. So to get started, if you look at banking and financial services first, there are stocks which have not done well at all for the past 7-8 years. Going forward, if you look at it purely from a valuation perspective, these boring names that you don't like are the ones which will do well. The stocks that people say have no growth, they're stagnant, they're boring businesses. And the stocks that, people like, the new age stocks, the NBFCs, would probably slow down on valuations alone. So, if I were to take a few examples, HDFC Bank, trading at a multiple of about 21. HDFC, the home loan company, merged with the bank, and it had to take 2 to 3 years for, the accounts to even out, for HDFC's loans and advances to be merged with HDFC Bank. Today, if you look at the split of revenue which HDFC gets, you will notice that this company gets a lot of its business, a lot of its revenue, not just from interest income, but it also gets a lot of revenue from fee-based income. In fact, about 51% revenue comes from net interest income, and 49% of it comes from insurance business, premiums they collect there, commissions, exchanges. Also keep in mind the net interest income, about 51%, which HDFC gets, has a large component of it now coming from home loans, auto loans, because after the merger of HDFC, which is the largest home loan company in India, it's got the lion's share in home loan market. This business will become really strong going forward, also because interest rates have come down, and housing in India is always going to be something that everybody hopes to have. It's a huge potential market. So with HDFC Bank, you get a housing finance company and a bank. Now again, I feel everybody is ignoring this. Everybody's because it's not really the vanilla flavor of the month. For the past few years, the bank has not performed well. Going forward, I expect this to change, because as I said, interest rate cuts will boost not just credit offtake, but also the demand in home loans and auto loans. At the same time, if you look at companies like CDSL and Bombay Stock Exchange, these companies, I don't for a minute deny the fact that there's financialization happening in India. Everyone's taken to, if you look at the mutual fund book, the SIP book has increased a lot. A lot more people are investing in mutual funds. A lot more people are investing in stocks. Demat accounts are opening at a record pace. People are moving away from traditional products like bank FDs. Whatever it may be, I don't think stocks like BSE and CDSL deserve a valuation of 68 to 70, which is where they're trading currently. I think they should be available at half these valuations for them to be attractive to buy. They may justify these valuations going forward because earnings will keep improving. As I said, I really like these businesses, but the prices at which they're trading, I wouldn't want to buy these businesses right now. At the same time, if I look at NBFC businesses, one business that I really like is a company which recently got listed, Tata Capital, which everyone knows was trading at 800, 850, about 900 odd levels in the grey market, but it got its IPO done at 332. Why I like this company is because it's a marvel at distribution. So I think the future belongs to NBFC companies which are big on distribution. Basically, they collect data from clients using all their APIs. They've got over 250 APIs. And APIs, to understand it simply, is a pre-made module on a website. So if you want to start a travel desk or a travel agency, you just take their API and it would do everything for you, from client onboarding to client KYC to disbursing a loan to the client for his travel, and everything can be done using their APIs. They have 250 APIs, which a lot of the top players in the markets are using. So they collect a lot of data to whom they can give out these loans. I've done a full video on that. I'll put a link to that below. So, Tata Capital right now where it's trading, I think in its own industry is probably best placed for a phenomenal growth from these valuations. Also because, I think the sentiment around Tata Group is quite negative because, the talk was RBI had asked them to list Tata Sons because it was considered as an upper layer NBFC. They've basically carved out Tata Capital because they did not want to list that, and they've put a bunch of businesses in Tata Capital, including Tata Motor Finance and the Tata New app, which is a super app. Right now it's not doing well, but it's a super app. It has the lion's share in the credit card market. They put all these businesses there. So I'm pretty positive that going forward, the earnings for Tata Capital will improve phenomenally, because before this, the earnings on the basis of which we are calculating the price earnings multiple does not include a few of the businesses which have come into Tata Capital. So that's a business that I really like. But, stocks like CDSL, BSE, good stocks, but trading extremely expensive. So, the second sector I'll take for this is energy and oil and gas. Now, I'm not going to cover stocks like ONGC, Chennai Petro, because these stocks I think will keep moving up and down in price. So whenever, let's say ONGC, whenever it trades below about 210, 220, its dividend yield becomes really attractive because the dividend it pays remains the same. And whenever it trades above 300, the yield is not so attractive. So I think they'll keep moving in that range, just like crude oil prices keep moving in a range. So, if it falls below that price, you may want to buy it. If it goes above that price, you may want to sell it. There's nothing fundamentally strong that, this is not a stock that any of the, upstream oil companies, I would not like to recommend it as, a 10-year buy and hold kind of stock. Yes, they pay 7-8%, 6-7% dividend. So to that extent, you may want to buy it. The stocks in energy space that I like the most right now are the trading companies, which is, something like a power trading corporation. It's India's largest power trading company, and it's entirely held by the government, so it handles 35 to 40% of total power traded in terms of electricity volume in the country. And the growth in the demand for power in India is 6 to 7% per year, and what will be needed going forward is to transmit power from the area where it's produced to the area which is deficient in it. So, PTC acts as a middleman there. It pays out a dividend of about 6% per annum. So, at the price at which it is trading, it's a great stock to buy. Now compare this with some of the power generation companies, something like an SJV and an NHPC. I'll give a disclosure. If you go back and see some of my past interviews and articles, I've spoken about SJV and it had been one of my favorite stocks. I'd recommended it. I had it in my portfolio for the longest time, but I sold it around the time when it went to about 104, 105 rupees. It went up to 160, 170 after that. I don't know why. And even right now where it's trading 90 rupees, I find it extremely expensive because, it's trading at a price to earnings multiple of about 51, 52. Now for a company which for the longest time traded in a single digit PE multiple number to be suddenly trading 7-8x that, it makes no sense. It's not like everything is going to become hydro and solar. We will still be producing electricity using thermal energy for the foreseeable future. So I am fairly certain that the price of a lot of these power generation companies will fall. What I really like in this sector is power transmission. And, I've already given my view on oil and gas. No matter how you look at it, if you're, looking at the next decade, oil and gas as a sector will not, there's tremendous headwinds for this sector. We have to reduce our reliance on traditional sources of fuel. So I don't think those stocks I would recommend someone to buy and hold for a long time. So, talking about the FMCG segment next, I've spoken about this many, many times. One of my favorite stocks right now has been and still remains ITC. And the reason is that, even though the stock has not been performing well and even though the earnings are not improving, and I will give you my view, I don't think the earnings are going to improve a lot, but the stock price will. The reason is that, when a company reaches the size and scale at which ITC is, the earnings, particularly in cigarettes business, cannot improve more than, the volume growth cannot be more than 6 to 7%. What ITC needs to do, which it will, is cut expenses and do premiumization, which will add to the margins, and the top line might improve 9 to 10%, but the bottom line can improve quite a bit. And keep in mind, besides cigarette, if you look at the top line, the revenue now the maximum revenue comes from its agri business. The first quarter earnings for 2026 showed a 38% increase in that revenue. If you talk about absolute numbers, then for the first quarter of 2026, agri business contributed about 9,600 crores of revenue compared to 8,500 crore from cigarettes. And I think it's the agri business, FMCG, non-cigarette business, paperboard and packaging business, hotels is obviously out. These three businesses are the ones where margins could improve. Cigarettes, if there is no more tax, no more increase in any kind of direct or indirect tax on tobacco or cigarettes as they're sold, then I believe that margins could improve there if raw material prices come down. Again, one of those stocks which is very boring, legacy, old school business, nobody wants to buy it. yet it's everywhere. You cannot miss it. Its products are available everywhere. It's a logistical marvel. There is an ITC shop literally every 100 to 20 meters in any city. Every panwala is a distributor of ITC. So this is a stock that I really like. What I don't like at this time is, as I said, some of these delivery companies like Eternal and Swiggy, by the way, is still a loss-making company. Eternal or Zomato is doing a lot. Blinkit is growing fairly fast. I am not doubting the fact that these businesses will be around. This is how the world will develop over the years. In fact, these businesses will grow tremendously, but the prices at which these stocks are trading, for these prices to be justified, these businesses have to grow 30 to 40x every year for the next few years. So I'm talking purely on valuations, and I would probably buy these stocks if they were available cheap, but unfortunately they're not. The other stock which is not available very cheap, it's trading at a multiple of about 53, 54, which is Hindustan Unilever. That's one stock where I think earnings can improve, because the reason why the stock is trading at that multiple is because earnings have not improved for HUL for a while, because they were not able to embrace this whole online selling model, get their products on Blinkit and adapt to the changing way in which sales are made. But now that they've premiumized a few of their products, they've recently acquired Minimalist. It's a debt-free company with very deep pockets. I'm pretty sure that they're going to continue with their acquisition spree, and they will get their own supply lines and get their own methods in which they sell their products in supermarkets and online. So that's another stock to watch out for. Slightly expensive, not as expensive as some of the other FMCG stocks are, like you look at Nestle or you look at Tata Consumer. I would avoid those two stocks, but ITC and HUL right now are my favorites. Now, many of you might feel that the stocks that I'm talking about are really boring, and my view is investments are supposed to be boring. You have to make your investments as boring as you can and do nothing and sit quietly. If you find something which is available at a reasonable or good valuation, buy it and leave it. You'll make a lot of money. Avoid these get rich quick, really expensive, highly valued stocks. And that's all you need to do in the long term. So talking of information technology, in IT, I've added two stocks to my portfolio. One, which, I've had for a long time. I've just increased my allocation. Again, you'll find it boring. But the other one, which you may find interesting, is Tata Technologies. Now, this is a company which I always liked since the time it did its IPO about 3 years back. But what I did not like at that time was the valuation at which it did its IPO. The stock got listed and went up to about 1,200 rupees a share. Today, the same Tata Technology stock is available or is trading at 680, 670 rupees in the market. And that's why I'm buying it right now. I really like automation, and it's a research and development company, and its main clients are, its own sister concern, which is Tata Motors, Jaguar Land Rover, but also Airbus and VinFast, a lot of these American companies. So, the possibilities in this area are immense, from home automation, electricity automation inside your house, to, automation inside the cars and automation inside aircrafts. A lot of money will be spent on research and engineering. So I really like this company, and it's got very, very marquee names as its clients. It's available at half the valuation at which it was trading when it did its IPO. I am in no doubt that this company will do extremely well going forward. The other stock I like in this space is Infosys. And again, I just started this video with an example of how Infosys was trading at a multiple of 200 in the year 2000, and since then till now the company's earnings have increased at a CAGR of 25%, yet the stock price has increased only at a CAGR of 8%. So 25% increase in earnings every year, and stock price is growing only 8% every year. The reason is that in the year 2000, the stock was trading at a price to earnings multiple of 200. yet it was, it was like the eternal of that year, the Zomato of the year 2000. And people bought it, just like they're buying Zomato today. Right now, it's available at a price to earnings multiple of about 23. It pays out a dividend close to 3% per annum. And one thing that everyone seems to be missing is the fact that Indian IT companies have started embracing AI better than anyone else. I don't know how this sounds, but we can duplicate and develop existing technologies and scale them up to provide services far better than the companies that originally developed them. So Infosys, in its annual report this year 24-25, prominently features Topaz as Infosys power of AI platform. Nia, which was the earlier version of it, it's productized AI stack that continues to be used for many industry solutions. In short, Infosys plans to move beyond simple automation, cost saving, into solving more complex business problems like forecasting, contract, and legal documentation, understanding customer behavior. So the short point is, it's not like Indian technology companies are not working with AI. In fact, they're working with AI at a mass scale. So right now, what you see with valuations is purely on account of a sentiment being really bad towards Indian IT companies, because AI came first in the West. Indian IT companies are late to adapt to it, and we've seen this happen before when cloud happened, and then when digital happened, and now when AI is being embraced. It's just always the same. Nasdaq and US IT companies move up first, and then Indian IT companies follow suit. So going forward, I'm pretty sure that Indian IT companies will benefit from, this will become the hub of not just adapting to AI, but also the way things are going, I think, for innovation in many ways. And I'm personally of the view that whenever this trade war settles between India and the US, whenever there is a concrete trade deal, you will see a massive relief rally coming in technology stocks. And I think that should happen in the next 1 year, maybe by the end of calendar year 2026. So the valuations at which these stocks are available, you should definitely buy these. So in addition to Tata Technologies, Infosys is another stock that I really like. Also, IT is one sector which, right now has such subdued investor sentiment. Nobody seems to be buying into Indian IT. So you don't have many stocks which are trading at extreme or high valuations. So, one approach could be to buy an IT sector fund, or, a mutual fund or an ETF which focuses on IT sector. You have stocks like Coforge trading at a multiple of 50 to 55, but the way the earnings are improving over there, I think that price to earnings multiple is justified. So I wouldn't pick up stocks in this sector which are trading at extreme valuations. I think I like this sector as a whole, and this is a good place to make some investments right now. So coming to pharma, there's many stocks I like in this space, but I'm going to talk about the stock that is available at the cheapest valuation out of the ones that I like. So, as an advice, I would tell someone looking to take exposure to the sector is to, maybe buy a pharma ETF or a pharma fund and, stagger your investments, because this is one sector which is, to my mind, likely to grow for the next 5-10 years. It's one of my favorite sectors in India. So with that disclosure, and I will say that I have, recently recommended some stocks which are trading at an extremely high valuations as well, because I think the earnings are likely to improve tremendously for those stocks. One being Laurus Lab as a disclosure, and the other which is trading fairly cheap, which is Natco Pharma. I explained, the whole video is available. If you want, you can look it up on my channel, and it's available at a price to earnings multiple about 8.28. But there's a reason why that is the case. It was traditionally always trading at 25-28. That's because one of their core drug, Revlimid, is going off patent in the US, which is about 70 to 75% of their revenue. So they're going to take a hit on that, but they filed a lot of new drug applications. And similar is the case with the stock, with the large cap pharma stock that I'm going to talk about today, which is Dr. Reddy's. And there's a lot of negative sentiment around the stock, again on account of the same medicine, because Revlimid is one of Dr. Reddy's big revenue earners. Dr. Reddy's gets about 42% of its revenue from the US. Let me see if I can pull up a chart there. So yeah, that's the chart. Gets about 42% of its revenue from the US, and Revlimid is a big part of that. The exact number is not disclosed, but even if it goes off patent, keep in mind the company has built a broad footprint in generics, active pharmaceutical ingredients, brand formulations. And the thing that's really good about Dr. Reddy's is that its revenue is pretty well split across various geographies. So the market, I think, has discounted it more than it should have. The company has taken steps to develop a lot more new formulations in biosimilars and even in generics. So I think going forward, it may take 18 months to 2 years before the earnings start improving, but be that as it may, if you factor that improvement in earnings to be anywhere above 12 to 14%, then this stock is fairly undervalued at the price at which it's trading. So this is one stock which you should keep adding gradually. You can even buy in a big lump sum amount right now and keep adding going forward, because with the kind of legacy this company has, the kind of products this company has, it's not going anywhere. There's a lot of growth levers, newer and higher value segments which the company is working on and developing. They've recently made a bunch of acquisitions. So all of this will play out going forward. And right now, as I said, it's available at a very attractive valuations with a very good margin of safety. So this is definitely a stock you should add. Now compare this. I see a lot of people not buying a stock like this or a stock like Natco, which I've explained in detail, available at single digit price to earnings multiple. Again, for reasons, of course, I get that. But people are buying a flavor of the month kind of segment, which is hospitals. And when I look at hospital stocks, they're trading at multiples of 80, 100, 120, 200. A lot of the earnings, a lot of the stock price movement on account of improved or perceived improvement in earnings has already got factored in. So I am in no doubt that India will need a lot more hospitals as insurance penetration grows, as earning capacities of Indians grow. Everyone can afford a better healthcare system. There's no doubt about that. But again, this whole video that I'm making is about valuations. So it's not like I don't like Max Hospitals, or I don't like Fortis, or I don't like Narayan Rudralaya. But it's just that I'm uncomfortable buying these stocks at price at which they're trading right now. And similar is the case with, I think, defense pack as a whole. The government is going to make a lot of investment in defense, and defense is definitely something which every country, India in particular, has to develop of its own. You have recently this whole talk about not buying defense equipment from the US because they can control the switch with which the damn aircraft works. So imagine being in a war zone and then they put off the switch so the missile systems won't work. You don't have to go in a war against them for them to put that switch off. You could be in a war against one of their allies. So going forward, a lot of money will be spent in defense. Indian defense companies should do well. But again, if you look at the valuations at which the listed companies are trading, it makes no sense. So the point that I was making this video, short point is, a lot of the stocks, in fact, I don't think there's any stock that I've spoken about in this video which I don't like, where I can say the company is bad. Even a company like Eternal, I think all of these companies are here to stay. They'll do very well. This video is about valuation, so you have to be really careful on what you're buying and the price at which you're buying it at. So a great stock at a very bad price is actually not going to make you any money, but even a mediocre stock, when you're getting it at a very cheap valuation, will make you better money than that. So keep that in mind.